Your wealth deserves stability, expertise, security. Your wealth deserves LGT Cresto, private wealth with over a century of global heritage.
Welcome to the Global View on this Friday. Well, let's get straight to that macro data. US inflation rising moderately last month. The consumer price index increasing 0.2% in July, matching the previous month with the annual inflation rate running at 3.2%, following a 3% rise in June, which was the smallest year-on-year gain since March 2021. Excluding the volatile food and energy categories, core CPI increased 4.7% after rising 4.8% in June. Higher rents were mostly offset by declining costs of goods such as motor vehicles and furniture. US Treasury yields rose on the inflation data, with the 10-year note up 8 basis points to 4.08 and the 2-year at 4.82%. And expectations of an additional 25 basis point interest rate hike have fallen further, with Fed funds futures now pricing in monetary tightening of around 8 basis points. San Francisco Fed President Mary Daly saying that while recent inflation data is moving in the right direction, more progress is needed, saying whether we raise another time or hold rates steady for a longer period, those things are yet to be determined, saying it would be premature to project what I think would happen because there's a lot of information coming in between now and our next meeting. Well, the US dollar did gain on that data, climbing to a 5-week high against the yen. The Aussie trading at 65.2. Well, for a review of what's going on at a macro level, but also particularly US earnings season and a look at market valuations, we're joined by Dave Sekera, Chief Market Strategist at Morningstar in the US. Dave, very good to catch up with you again. Thanks so much for joining us. Let's just start with your observations, given that that key inflation read we had. What are your thoughts?
It's really in line with what we were expecting. The headline number was a little bit better than what the market was expecting. The core reading was in line. I did talk to our U.S. economist today, and one part that he thought was really encouraging to him is that the impact of falling used car prices was actually lower than what he expected. So that's actually going to continue to be disinflationary for the next reading or two. He also forecast that shelter and housing costs, are both on a downward trend. So we still see inflation, continuing to moderate over the course of this year. In fact, we expect inflation to get down to a 2% year-over-year run rate by the end of the year. And he's actually looking for inflation in the U.S. to average just under 2% in 2024. So I think that supports our view. We think the Fed is done. We think that the tightening of this monetary policy cycle is over. And in fact, we think the next move from the Fed will probably be to start loosening rates, and that could be as early as February of 2024.
Well, Dave, with a view as to what is informing your investment decisions at the moment, how do you feel as though the US economy is tracking?
Well, it's actually a really interesting question. So we do think that the U.S. economy is going to slow. We expect it's going to slow sequentially for the next 3 quarters until it bottoms out in the first quarter of 2024. Now, I do think that the potential upside surprise could be that the economy could be actually stronger than expected, here in the third quarter. It's really early at this point, but I think the question might actually be, is third quarter going to be like a repeat of the second quarter where everyone expected it to be slow, but it actually ends up coming in, faster than expected. I would note that the Atlanta Fed, with their GDP now number, that's actually at 4%. I think that's probably a lot higher than we'll end up seeing. But again, I do think it shows that the economy is actually still doing better than most people expect.
Well, we'll get into specific stocks in just a moment, clearly in the wake of earnings season, with some more to come as well. But overall, Dave, how are you looking at the US market valuation?
So the overall market, we're up over 17%, year to date here in the U.S. Now, we came into the year, at very undervalued levels, but following that rally, we think we're really starting to approach fair value at this point in time. So we're really getting close to that point where the overall market is going to be in line with kind of that composite of the fair valuations as determined by our team. So I think at this point, it's really now a good time. Investors should be taking a look at their portfolio. August is a great time to do that. Things will start slowing down now the earnings are slowing down, and really look for those stocks that are overvalued, overextended, lock in profits, go ahead and sell those. And I think now's a good time to look to see where those undervalued opportunities remain, those that have lagged the market, and be able to reinvest in that. Just a lot of repositioning at this point.
Any particular sectors that you're looking at having reasonable or attractive value at this point?
Yeah, so communications, that was the most undervalued sector by far in our view coming into the year. It's up 42%, at this point, yet it's still the most undervalued, trading at a 20% discount to our fair value. Now, of course, you can't talk communications without talking about Alphabet and Meta. Meta has gone up so much, it's actually now at a 3-star level, trading pretty close to our fair valuation. We do think Alphabet still has further to run. That's a 4-star rated stock, trades at a 20% discount. But we do see a lot of value among more traditional media and communications names. Two that have been in the news a lot in the past couple of weeks in the U.S. are AT&T and Verizon. Those are both rated 5 stars. They trade at about a 40% discount to fair value, and they pay a 7% dividend yield. I think what's most attractive there is we do think that there's a shift in the wireless industry, that it's going to be changing more into like an oligopoly now that there's been a lot of mergers and acquisitions in that area. And as such, we expect going forward that there's going to be less competition on price. And so we are looking for margins over the next couple of years to improve.
Dave, before we get into specific stocks you're liking, particularly in the wake of earnings season, what has been your takeaways out of earnings season, given we're close to the end now?
Yeah, so last time we talked, we had thought that it's going to be a good earnings season, and that's actually how things have turned out. So overall, earnings in and of themselves, are lower than what they were on a year-over-year basis, but they are coming in, better than what expectations were. I think that's a combination that management had given pretty conservative guidance, coming into the quarter, and the U.S. economy being stronger than expected. I think what's been most interesting to me is really looking at the bifurcation of the market between, the virtual and the online world. That's doing very well, exhibiting still very strong growth. Think Alphabet, Microsoft, Amazon, Meta, all had, good beats, good guidance. So still a lot of strength there. Whereas the companies that are tied to the real world, in-person world, are showing much more mixed results. Then we break down into the industrials. Now, the short cycle industrials, we are still seeing continued economic weakness there, and that began, last quarter. But the long cycle industrials, the durables, not only have they not been impacted. I talked to our industrials analyst today, and he said he's still seeing, very strong backlogs there. Any industrials that are tied to infrastructure are in great shape. He pointed out Eaton as being one, that has, really given good guidance. I'd also highlight the engineering and the construction firms. Those should have some good tailwinds behind them as well. And then lastly, among the consumer, there has been some disappointments. The top line's been weaker there, and I think a lot of those companies are still struggling to put through, some of their inflationary cost inputs. 3M would be, one there. So overall, I do think that supports our economic outlook, looking for a slowing rate of economic growth, but no recession.
All right, so let's perhaps look at those consumer-facing stocks with some earnings reports to come, given, of course, consumer spending is under severe pressure.
Exactly. So I think, this coming week, it's really going to be all about, the state of and then the outlook for the U.S. consumer. And again, the U.S. consumer has been under a lot of pressure. We have had inflation, growing faster than wages for, I think, almost 2 years. Now that has, over the past couple months, started to reverse. We're now starting to outpace inflation with wages. But the question is, has that enough, and will that really offset some of the damage? So first up is going to be Home Depot. Now I'm going to keep a close eye on the number of transactions, the average sales per transaction, because I think what we've been seeing there is the trend towards, smaller projects, more projects that are non-discretionary as opposed to remodeling. That is a stock that I'd be very careful of going into earnings. We do think it's overvalued. It's rated 2 stars, trades at a 27% premium to our fair value. In the middle of the week, we've got Walmart and Target. So between these two, that really provides us the broadest view of the state of the U.S. consumer. So there's really three specific things going to be listening for. So first, are consumers shifting, more of their spending into grocery and away from goods? Second, are consumers, trading down to private label from branded? And then lastly, are consumers buying, fewer items per trip? And I think if the answer to, one or more of these is yes, I think that's going to indicate that consumers are under pressure. The other two stocks I would highlight, I'm watching for two different reasons. So first is going to be Estee Lauder. And really, I'm going to look for an indication of what's going on with the upper end consumer. They do sell premium beauty care, cosmetics. This is one where, we do think that stock has sold off, too much. It's a 5-star rated stock. It's a 34% discount to our fair value. In fact, our analyst just recently added that to our best ideas list. So she did note, there are still some challenges, but she thinks those challenges here are more cyclical and not structural. And for long-term investors, she specifically pointed out, that she thinks it has very good growth prospects going forward. I think about a third of their revenue is tied to the emerging markets. And then on the flip side of the coin is going to be a TJX, which is an off-price retailer. So I'll be looking at them as far as what's going on with more of the value-conscious consumer. So I do think that in an economic environment where it's slowing, it's a good value proposition. But I believe that's already reflected in that stock. It's up 37% over the past year. So again, that's a 2-star rated stock, trades at a 22% premium. So I would be careful going into earnings on that one.
So Dave, given those earnings we've seen then, what stocks have you identified that you're seeing attractive right now?
All right. Well, I bought a couple of them this time around, which I think are going to be a little bit more interesting, a little bit more story stocks. So the first one's going to be Cognizant Technology. So it's a global IT services provider, for consulting and outsourcing. So they beat earnings, they raise guidance. That stock is up 7% after earnings. Our investment thesis here is that they're a beneficiary just not of only long-term digital transformation trends, but also specifically for artificial intelligence. We think it's a strong company. We've assigned a narrow economic moat. It's rated 4 stars, trades at a 25% discount to fair value, also pays a little bit under a 2% dividend yield. The next one up is a smaller company. It's a Jacob Solutions. It's in the engineering and construction business. Now, earnings there were in line with our expectations. Management did reiterate its 2023 EPS outlook, but I think there's a lot of positive momentum here that's going to carry that into 2024. We are seeing a lot of infrastructure spending, really getting rolled out from the Inflation Reduction Act, and these are on multi-year projects. So in this case, I think the market liked what it heard. That stock up 7% on the week. We still think it's 13% undervalued. It's rated 4 stars. Another story stock is going to be RTX Corp. So that was formerly known as Raytheon. Now, this one is interesting. It did drop a little while ago by 10%. It reported that its Pratt and Whitney engines are going to have to undergo inspection for microscopic cracks. Now, we did adjust our model to incorporate that, but we think the market's overestimating that issue. And I think they got into kind of a sell first, ask questions later kind of mind frame. So following earnings, we liked what we heard. We increased our fair value to $112 a share. Our analysts specifically highlighted, very strong bookings and resupply contracts, high quality business with a wide economic moat, 4-star rated stock, trades at a 23% discount, 2.5% dividend yield. And then, another quick one, let's go with American Towers. So it's a REIT that owns cell phone towers. And I would just note here, for years, all of these cell phone REITs were, in our view, significantly overvalued. We really couldn't understand how the market was valuing these. They started coming down in 2022. That downward momentum has continued into 2023. And we think that they're now getting to the point that they're starting to look attractive. This one beat consensus and earnings for the second quarter. They raised their guidance. So I do think this one is an interesting one to take a look at. 4-star rated stock, trades at an 18% discount, a 3.3% dividend yield.
Dave, unfortunately we're out of time, but you have given us a comprehensive look at earnings season and what you're liking right there. Really appreciate that. Thanks so much for joining us from Morningstar.
Of course. Thank you.
All right, that is the Global View for this Friday. Stay with us. The Open is just moments away.